Good day, and thank you for standing by. Welcome to the Tower Semiconductor second quarter 2026 earnings conference call and webcast. At this time, all participants are in listen-only mode. After the speaker's presentation, there will be the question and answer session. To ask a question during the session, you need to press star 11 on your telephone keypad. You will then hear an automatic message advising your hand is raised. To withdraw a question, please press star 1 and 1 again. Please be advised that today's conference is being recorded. I would now like to hand the conference over to our first speaker today, Noit Levy. Please go ahead.
Thank you. Hello, everyone, and thank you for joining us. Welcome to Tower Semiconductor second quarter of 2026 financial results conference call. With us today are Mr. Russell Ellwanger, Chief Executive Officer, and Mr. Oren Shirazi, Chief Financial Officer. Before we begin, please note that certain statements made during today's call may be forward-looking and are subject to risks and uncertainties that could cause actual results to differ materially. These risks are detailed in our SEC filings, Form 20F and 6K, as well as filings with the Israeli Securities Authority, all available on our website. Tower assumes no obligation to update forward-looking statements. Our second quarter 2026 results are prepared in accordance with U.S. GAAP. Some data presented may include non-GAAP financial measures as defined under SEC Regulation G. Reconciliation to GAAP figures and full explanations are provided in today's press release and financial tables. For your reference, a supporting slide deck is available on our website and integrated into this webcast. With that, I'd like to turn the call over to our CEO, Mr. Russell Ellwanger. Russell?
Hello, everyone. Thank you for joining our call today. I'm truly excited to share with you the status, progress, and future outlook potentials for Tower. The second quarter was quite significant, setting substantial company records across all key metrics. These results continue to validate the growing value of our technology portfolio and the powerful operating leverage embedded in our business model. Our revenue is on a fervent growth trajectory with an accelerated flow-through into earnings. Second quarter revenue was $460 million, with a particularly positive profitability, 30% gross margin, 20% operating margin, and 20% net margin, all being company records, excluding non-recurring accounting items, and representing respectively 58%, 55%, and 55% quarter-over-quarter contribution from the increased revenue. These results stand as the first step of continual margin expansion we expect over the next years, driven by market-leading customer partnerships, which dictate a very rich product mix backed by strong operational execution. Looking ahead, we guide the third quarter of 2026 mid-range revenue to be $520 million, representing an annualized revenue run rate of above $2 billion. We began the year stating that Tower will have a very strong second half as the previously announced capacity investments become qualified and converted into shipments. Beginning the second half of 2026 with a $2 billion run rate turns the page into multiple new exciting chapters for the company. The strength of our customer demand, our growing partnerships, our proven execution capabilities, and the strategic investments that we have and still continue to announce provide a powerful catalyst to accelerate our short, mid, and long-term growth. Due to direct and growing customer demand, representing the scale of the market opportunity, and more importantly, our ability to capture it, we have updated our 2028 model to be $3.6 billion in revenues, $1.63 billion in gross profit, or 45% gross profit margin, and $1.2 billion in net profit, or 33% net profit margin. Please see slides 4 and 5. Very important, the profitability gains we delivered in the second quarter are not a one-time achievement, but rather just an initial step towards profitability expansion and cash generation as represented in our updated 2028 model. Equally important, as can be seen in slides 4 and 5, this growth is accompanied by even greater efficiency. Today, we operate at about a 10 percentage point difference between gross margin and operating margin, a highly efficient structure for a company investing strongly in future growth. As revenue expands, we drive greater efficiency, with operating expenses as a percentage of revenue lowering to approximately 7%, 30% lower than current levels. This improvement is not the result of limiting investment in R&D, to the exact opposite. The model includes an increase of R&D investment by over 40% against present levels. Rather, this improvement reflects the enhanced efficiency achieved through our support functions as we grow scale. Speed and execution are one of the primary differentiators for high-tech success. We must continue to invest in R&D. This is a core capability. But as well, there must be a focus to streamline context, all of the SG&A functions. We are doing this, and likely with numbers that rival or exceed the otherwise best in the industry. Efficiency, driving the speed of execution, of course, yields strong margins. But more importantly, it enables sustained business success through the speed of execution. 3 weeks ago, we announced a dual-track 300mm capacity strategic expansion in Japan for our silicon photonics, silicon germanium, and advanced optical packaging capabilities, having gained the support of the government of Japan through the Ministry of Economics, Trade and Industry, METI. By combining Tower's specialized technology leadership and our best of the best worldwide workforce into Japan's unparalleled manufacturing expertise and quality output, its world-class research institutions, and deeply committed workforce, we are building a strategic platform that will drive innovation, economic growth, and semiconductor leadership for decades to come. Track 1 of this dual track adds significant new 300mm silicon photonics capacity with full production readiness expected during the fourth quarter of 2027. It consists of repurposing the RI facility, formerly Fab 6, for 300mm silicon photonics capacity and advanced packaging capabilities, and as well maximizing the company's Fab 7 300mm output in Wozu. This Track 1 is the driver for updating the 2028 business model. Track 2 will commence in parallel with the first track and consists of constructing an additional 300mm manufacturing facility adjacent to Fab 7. This facility is expected to provide a 4x increase in our Japanese 300mm manufacturing output, focusing on silicon photonics, silicon germanium, and related advanced optical packaging, positioning Tower to continue to support our accelerating customer demand for emerging AI and data center applications, driving next-generation optical connectivity requirements, and is planned to provide a seamless path for Tower and our customers for continued growth post-2028. Moving to our businesses, please refer to slide 6 as reference for Q2 revenue breakdown. Our RF infrastructure revenues for the second quarter represented 49% of corporate revenue, with approximately 43% of quarter-over-quarter growth and over 140% year-over-year growth. Silicon photonics revenue itself increased by over 60% quarter-over-quarter and over 270% year-over-year, hitting a Q2 annualized run rate of over $680 million, targeting a $1 billion run rate in Q4 26, as the previously announced capacity expansion continues to be qualified. The full ramp of wafer starts in these investments is anticipated to occur within the fourth quarter of 2026, creating a wafer start capacity over 3 times higher than the second quarter silicon photonics revenue shipments. with full financial effect anticipated to be in the second quarter of 2027. After kicking off the year with several breakthrough technology milestones, the second quarter was about further propelling Tower's leadership position in silicon photonics as an added foundation to the next phase of growth. We focused on expanding capacity, advancing our technology capabilities, and deepening our engagements with strategic customers aligned to their long-term roadmaps. The data center industry is undergoing a fundamental transformation as AI performance is no longer defined solely by compute. It is increasingly determined by how efficiently data moves between processors. High bandwidth, low latency, energy-efficient optical connects have become a critical enabler of AI infrastructure, while geographically distributed deployment has become equally important to hyperscalers and the communities. These trends align directly with Tower's core strengths. As AI clusters scale from thousands to hundreds of thousands of XPUs, electrical interconnects are rapidly approaching their practical limits. Silicon photonics has emerged as the leading platform for 800G and 1.6T pluggable optical interconnects, which have, for the most part, already replaced copper for scale-out connections outside the rack. The next frontier is enabling optical interconnects for scale-up, either within a single rack or across multiple racks. And once again, silicon photonics with Tower is well positioned to lead this transition with several near-package optics NPO deployments planned over the next year and many more in design. NPO delivers much greater bandwidth density at reduced energy per bit compared to pluggable optics, and yet it leverages the same established ecosystem as pluggables, overcoming the reservations from hyperscalers and data center operators about reliability, serviceability, or multi-source flexibility. We announced customer contracts representing approximately $1.3 billion of silicon photonics revenue for 2027, with even higher growth for 2028. With what we've stated about Track 1 investment, substantial additional 300mm capacity will be added throughout 2027. This added 300mm capacity is already requested by and committed to several lead customers, reflecting their confidence in Tower's ability not only to scale manufacturing capacity rapidly, but to continue to execute on highly differentiated technology roadmaps required for future networking architectures. To support the long-term growing demand, we announced a Track 2, a most significant expansion of our manufacturing footprint in Japan, which is expected to more than quadruple its 300mm capacity, positioning Tower well to support not only today's workhorse pluggable optics and our rapidly growing near-package optics, but also the additional future market for co-package optics. Capacity alone, however, is not enough. Our future growth will also be driven by the next generation of enabling technologies that are already moving through development pipeline. Over the next 1 to 2 years, we expect several of these technologies to transition into high-volume manufacturing, including and especially heterogeneous integration of 3-5 materials on silicon photonics for integrated lasers, advanced modulators, and optical signal processing. In support of this roadmap, we entered into a multi-year epitaxial wafer supply agreement with IQE, securing a strategic supply of 3-5 epitaxial material while continuing to internalize key manufacturing steps that enhance both performance and supply chain control. Our long-standing collaboration with Marvell reached an important milestone as the number of SiPho-based coherent optical modules crossed over into multi-millions. This achievement demonstrates Tower's ability to manufacture some of the industry's most complex silicon photonics ICs at high-volume production scale. Looking ahead, coherent photonics is expected to play an increasingly important role in scale-across AI architectures, where multiple data center campuses operate as a single AI factory while distributing power, cooling, and infrastructure requirements across geographically diverse locations. Our silicon germanium business continues to benefit from growing demand for low latency, low power, efficient analog drivers and transimpedance amplifiers across traditional pluggables, as well as linear pluggable optics and linear receive optics architectures. Our 100G per lane and 200G per lane products are in high volume production across all three 200mm fabs as we advance towards near package optics as well as 400G per lane solutions requiring tighter electrical IC, photonics IC integration, and co-design. We're also seeing strong customer pull for our next generation 300mm silicon germanium platforms. Our RF mobile revenue represented 12% of our second quarter corporate revenues. As we discussed last quarter, our RF SOI business is undergoing a strategic transition from 200mm to 300mm manufacturing, enabling higher performance, greater integration, and stronger value for our customers. In addition, we are consolidating 300mm RF SOI manufacturing to Fab 7, to Fab 10, freeing up Fab 7 capacity for a rapidly growing SiPho and silicon germanium business. These factors resulted in a 14% decrease in our 300mm year-over-year RF SOI revenues. Looking forward, we've realized very strong design win momentum for our 300mm platform, particularly for premium smartphones. A roadmap replete with best-in-industry figures of merit has gained market excitement and engagement, driving an expected 3x RF SOI increase in 300mm wafer starts by mid-2027 against the Q2 26 shipments. Power management revenue for the second quarter represented 14% of corporate revenues, with year-over-year revenue growth and strong demand for both our 200mm and 300mm BCD offerings. Our technology focus on power delivery for high-performance computing gives us a leadership position in low gate charge and low RDS(on) LDMOS devices. Our latest generation power technology enables our customers to develop high-frequency, high-efficiency DC-to-DC converters for a variety of growth segments. During this quarter, we experienced increased demand from existing customers and also saw very strong new customer acquisitions across our power portfolio. This momentum is primarily driven by growth sectors where power density and thermal efficiency are mission critical. Through close collaboration with our lead customers, we continue to advance our next generation power management roadmap. Sensor display for the second quarter represented 12% of our corporate revenue. In our image sensor business, year-over-year revenue is predominantly flat. However, we're seeing a sharp surge in demand, particularly in the machine vision market, for high-end, high-resolution sensors used in semiconductor inspection, driven by the accelerated build-out of DDR and HBM memory assembly lines, and as well in the automotive industry, especially for EV battery inspection. This strong demand is expected to continue to grow over the next 2 years. We are well positioned to support it with a range of products our lead customers have developed on our state-of-the-art global shutter 300mm platform. Looking at utilization, during a period of high capacity ramp, Fab 2, Fab 3, and Fab 9 200mm fabs operate at utilization rates between 80 and 85%. Fab 5 in Japan was at 75% utilization. Fab 7 continues to be fully utilized, well above our 85% utilization model. Now I'd like to turn the call to our CFO, Mr. Oren Shirazi. Please, Oren. Thank you.
Thank you. Hello, everyone. Earlier today, we released our financial results for the second quarter of 2026. I will now review the highlights of these results, as well as the balance sheet, CapEx investments, and our updated business model. First, looking into the P&L. Revenue for the second quarter of 2026 was $460 million, a record in the company's history, representing 11% quarter-over-quarter growth, compared to $414 million in the first quarter of 2026, and 24% year-over-year growth, compared to $372 million in the second quarter of 2025. Gross profit for the second quarter of 2026 was a record $138 million, reflecting a 30% gross margin and an increase of 72% compared to $80 million in the second quarter of 2025. Operating profit for the second quarter of 2026 was $90 million, 2.26 times the operating profit in the second quarter of 2025. Net profit for the second quarter of 2026 was $91 million, reflecting a 20% net margin, and an increase of 95% or $44 million compared to net profit of $47 million in the second quarter of 2025. Earnings per share for the second quarter of 2026 were 80 cents per share basic and 79 cents diluted, almost double the 49 cents basic and 41 cents diluted in the second quarter of 2025. Moving to our balance sheet. As we previously announced, we received $290 million in prepayments from SIFO customers in the first quarter of 2026, mostly towards 2027 capacity reservation. These customer prepayments are included in the balance sheet as of the end of June 2026 as liabilities under short and long-term customer advances, and are included in the cash flow report for Q1 26 and for H1 26 as cash from operating activities. Our balance sheet continues to be strong, evidenced by the following indicators and financial ratios. As of the end of June 2026, our assets totaled $3.8 billion, primarily comprised of $1.6 billion in net fixed assets, predominantly fab machinery, and $2 billion of current assets. Our current ratio remains very strong at about 4.9x, while shareholders' equity reached a record of $3.1 billion at the end of June 2026. Hedging. I would like now to describe our currency hedging activities. Regarding the Japanese yen, since the majority of TPS cost revenue is denominated in yen, and the vast majority of TPS costs are also in yen, we have a natural hedge over most of our Japanese business and operations. To mitigate part of the remaining yen exposure, we execute zero-cost cylinder transactions to hedge currency fluctuations. Hence, while the yen exchange rate against the dollar may fluctuate, there is limited impact on our margins. Regarding the Israeli shekel, while we have no revenue in this currency, a portion of our cost in Israel is denominated in shekels, so we also hedge a large portion of that currency risk by entering into zero-cost cylinder transactions to mitigate this exposure. Hence, while the shekel exchange rate against the US dollar may fluctuate, the impact on our margin is limited, as seen over the past few quarters, during which the shekel appreciated strongly against the US dollar. Now moving to our CapEx investment plan. As previously announced, in order to support the increasing SiPho and 5G demand, we are executing a $920 million investment plan to expand capacity and capability of 5G and SiPho equipment across our 8-inch fabs in Israel, Newport Beach, and Texas, as well as our 12-inch Uzo fab in Japan. This investment is on track in terms of purchase orders issued, technology and process qualification, equipment arrivals, and ramp plans. Approximately 50% of this $920 million CapEx investment has been paid to date and is included in our cash flow for investing activities for the reporting period through the second quarter of 2026, while the remaining 50% is expected to be paid during H2 26 and full year 2027. Business model. As recently announced and presented earlier today by Russell, the company updated its business model, which now includes the planned investment in the Arai facility, formerly Fab 6, to repurpose it for 12-inch SiPho wafer manufacturing, thereby maximizing the company's 12-inch wafer output in Japan, supported by METI, Japan's Ministry of Economic, Trade and Industry. The updated model is based on forward-looking operational, business, and financial assumptions, including the assumption that all fabs will operate at 85% utilization post the full installation and qualification of the $920 million in SiPho and SiPho CapEx investment. We continue to execute to ramp up SiPho and 5G capacity and capability in our fabs 2, 3, 5, and 7, and post the planned repurposing of the Arai facilities, the qualification of the new equipment tools to be installed there. Another assumption is the assumption regarding forward-looking wafer selling prices for existing and future products and flow. And forward-looking assumptions regarding cost and completion dates for the successful qualification of tools to be installed, process technologies to be qualified, and customer products to be qualified and ordered from the company. Under the updated model, we target $3.6 billion in annual revenue, which is $760 million higher than the February model target, reflecting 27% revenue increase. $1.653 billion annual gross profit, resulting in a 45% gross margin as compared to 39% in the prior model. This annual gross profit is $510 million higher than the prior February 2026 model, representing 67% incremental gross profit derived from the incremental $760 million revenue, reflecting our enhanced product mix. $1.38 billion of annual operating profit, resulting in a 38% operating margin as compared to 32% in the prior model. This annual operating profit is $480 million higher than the prior February 2026 model, representing 63% incremental operating profit derived from the incremental $760 million revenue, again reflecting our enhanced product mix. And lastly, $1.2 billion in annual net profit, resulting in a 33% net margin as compared to 26% in the prior model, and as compared to 20% in the second quarter of 2026. This annual net profit is $450 million higher than the prior February 2026 model, representing 59% incremental net profit derived from the incremental $760 million of additional revenue, reflecting our enhanced product mix. That concludes my prepared remarks. Now I'd like to turn the call back to the operator so we can take your questions.
Thank you so much. Dear participants, as a reminder, if you wish to ask a question, please press *11 on your telephone keypad and wait for your name to be announced. To withdraw a question, please press *1 and 1 again. Please stand by, we'll compile the Q&A roster. This will take a few moments. And now we're going to take our first question. And it comes to the line of Cody Acree from Benchmark StoneX. Your line is open. Please ask your question.
Hi, Cody. Thanks for taking my questions. Hey, guys. Congrats on another great quarter and straight execution. Congrats to everybody. Just a point of clarification and a couple quick questions. Did you update the SiPho bookings number for 27, the $1.3 billion? Did you give a new version of that?
No, I did not. I stated in the script that the Q4 start rate, which would be fully realized in Q2 27 revenue, was 3 times higher than the Q2 shipment. So that number is...
Yeah, this can be 680 times 3, but this is capacity. While the $1.3 billion is on customer committed repayment, so on customer committed contract.
Although as stated additionally, the capacity growth is spoken for. Is it all booked? No, but it's spoken for. So I
Is it
think
fair to say? Sorry,
Go ahead.
can you touch off?
No, I was just going to state that I think there was no update given on the contracts and the bookings, but there was an update given pretty much on what is started or will be started for shipments.
Okay, excellent. Thank you for that. And then just with that level of visibility, you've been able to put up some record sequential and annual growth rates, both on a percentage and on a dollar basis. It's been pretty impressive. With this level of visibility, can you maybe just handicap the likelihood of being able to sustain this kind of growth rates or even accelerate from here?
Well, we gave the 2028 financial model and stated that it is our expectation to reach those numbers at a minimum by run rate, nominally in the full year, in 2028. So I think you could estimate what the growth rate is off of a $3.6 billion 2028 revenue level.
Okay, and then lastly, Russell, maybe if you can just help me to get a scale on the Japanese projects, the Track 1 and Track 2. I'm just trying to understand the wafer volumes or the revenue support that ultimately will be available out of Japan. Not so much Track 1, I think that's clear in your fiscal 28 model. That is assuming full utilization of that Track 1 build out. Is that the right way to think about it?
Yeah, 85% utilization, correct.
Okay. And so then how do we think about the scale of Track 2?
We stated that the Track 2 would quadruple the 300 millimeter capacity, and that it's predominantly for SiPho and SiGe. We didn't give specific numbers. Part of the reason for not giving numbers is that we're in final negotiations, strong negotiations, not on the pricing part of it, just on the timing part, to complete the facility and complete the facilitization of the facility, and then the negotiations with the suppliers on the equipment itself. So budgets, everything's approved, everything is there. We're focused on covering everything with internal cash creation. So it sits nicely in our hands. We're not looking at anything being gated or leveraged by a fundraising event or anything of the sort. There's no dilution within the plans. But we don't yet at this point have the final schedule of tool installations and tool qualifications. Our target is that everything is installed and functioning by Q4 2028, and as stated in the script, that it then provides a seamless growth trajectory into 2029, having reached the full potential of the Track 1 development in 2028. So our target would be to have that grow from there. The exact numbers of how much we would get from that we haven't said. And it's not necessarily our desire to give quarterly updates and financial models. But
Sure.
You could expect that within the first quarters, as we get into 2027, that will update a long-term financial model, depending upon how it actually turns out on the final build-out of the factory and the amount of tools that we can fit into the built-out factory. So some of that, even some of the building plan, is not yet finalized.
Okay, excellent. Thank you for that detail. And then just to be clear, that the 4X quadrupling of the capacity of Track 2, that is just the Wozu facility, or is that quadrupling counting Fab 6?
We're including Fab 6 in that 4X number. So whatever we would be doing incrementally in Fab 6, which predominantly we'll be using as an epicenter, and also for specialty packaging tools. But yes, the Fab 6 incremental that you see in Track 1 is included into the 4X.
All right, that's very helpful. Thank you, guys.
Thank you. Now we're going to take our next question. And the question comes to the line of Masti Hosseini from SIG. Your line is open. Please ask the question.
Yes, thanks for taking my question. I do have a couple. Russell, I just want to better understand the evolving end market demand. As we look into next year and NPO becomes material, does that give you ability to increase your content per given transceiver?
To the extent I understand your question, I would say no. It basically would be, we would be selling an MPO in those cases rather than selling a pluggable, and in many instances most likely be selling both. But the content itself, no, at least to the extent that I understand your question.
Sure. I'm trying to better understand if there is synergy here, especially as I'm under assumption that at some point the PIC itself will require a stacking of SiGe and SiPho, and that's where the question is originating from. If we have more of a heterogeneous structure, a PIC-based structure, would that, I imagine that would be more positive for you, and I just want to see if I'm in the right frame of mind.
I think you're in the correct frame of mind, and I think the answer is yes. But I believe that focuses more not on MPO, but on next generation. So where we talked about the advanced packaging, a good amount of the advanced packaging that we're putting in place is die-to-wafer and wafer-to-wafer bonding.
Okay, thank you. And I imagine that would also require you to increase SiGe capacity, and that's already embedded in the phase 1 of the capacity expansion, right?
To some extent, it's mainly embedded into the phase 2.
Okay.
Phase 1 is focused very strong. I'm sorry. Phase 1 is focused very, very strong directly on SiPho expansion, where we, as stated, all of that growth that we're doing in phase 1 is already spoken for.
Okay, great. And then second question regarding your manufacturing footprint. Given your emphasis in Japan and how you have this phase 1 and phase 2, should I assume that majority of your U.S.-based customers would be supported through facilities in Japan, or U.S. would present another area where you eventually have to increase capacity?
We have and we continue to increase capacity in both Newport Beach and in San Antonio, and we're still planning to increase further capacity in both sites. But one of the reasons for having chosen Japan, is its geopolitical neutrality. It's, there's no issues for somebody to be supplied out of Japan. So it's a very good place to grow. I mean, there's multiple reasons to want to have chosen Japan. We have truly a remarkable workforce there. Most of the R&D that we have in Japan was a derivative of Panasonic hires back when Panasonic was the creme de la creme. I mean, a top 3 Japanese company, and hiring their choice of people predominantly from Tokyo University. So we still have an extremely capable core workforce as far as R&D. Additionally, anybody in the world that's ever been around Japanese manufacturing, the quality of it is just outstanding. It's part of a Japanese mentality. I mean, ancillary here, but we lived in Japan for a number of years when our youngest daughter was going through kindergarten. And it's a very, very interesting thing. Already at 3.5, 4 years of age, when a kindergarten student goes to school, part of their uniform is a plastic container with a washcloth in it called an oshibori. And the school day starts by taking out that washcloth and wiping down their desk. And the school day ends by taking out that washcloth and wiping down their desk. The honoring of the workplace is a very, very big thing in Japan. And that culture, when you start at 3.5, 4 years of age, learning to honor the workplace, that stays with you forever. I mean, I did a film once, it was kind of funny, just about the procedure of returning your tray and dishes after lunch. And the activities in Japan, it's more or less of an assembly line. You know, there's absolutely no degradation of a quality mentality versus when they're in the regular factory. So when it deals with, very, very high quality manufacturing, I think Japan is really the best of the best. So those are multiple reasons for going there. It was, the taxonomy that we have of workforce is fantastic. Quality culture in Japan is fantastic. Education in Japan is amazingly good. And it's geopolitically neutral.
Got it. Thanks for all the detail. And just very quick follow-up. When should RF mobile revenue stabilize? Your prepared remarks suggest that you're continuing to consolidate, move manufacturing to 300 millimeter. Would those changes in your manufacturing footprint stabilize into the second half, or is this something that is going to carry on into 27?
I wouldn't use the term stabilize. Stabilize would mean going into an area where you're not having incremental growth. But I believe I had stated that from the tape-outs activity, the design activity that we've already won, that we would see Q2, Q3 of next year having the largest 300 millimeter manufacturing that we've ever done for RF SOI. So, but I wouldn't say stabilizing. It's just getting to a point of continued growth, and then additional plans. How do we grow it beyond that? But I would think that for the Fab 10 factory where we're manufacturing, it will be very, very full come second, third quarter of next year.
Got it. Thank you.
You're very welcome. Good question.
Thank you so much. And now we're going to take our next question. And the question comes to the line of Richard Shannon from Craig-Hallum Capital Group, LLC. Your line is open. Please ask your question.
Hey, Richard.
Great. Russell, hi. How are you?
Good, thank you.
Excellent. I'll echo congratulations on wonderful results. Keep up the good work here. My first question is going to be a follow-on from a couple of Cody's questions here and trying to think about the ultimate silicon photonics inside G 300 millimeter capacity after you finish track 2, and you use the statements of 4x increase in capacity, I think at least 4x capacity. So it seems like we need to understand and characterize how much of the capacity to that point is 200 versus 300. So I was wondering if you could answer that quantitatively, or at least qualitatively, to help us think about that more specifically.
I'm honestly not sure I understand the question. Could you just restate it, please?
Sure. You've said that after track 2, it's going to increase your 300 millimeter silicon photonics and SiGe capacity for quadrupling. So in order for us to quantify this, I think we need to understand what that mix of capacity between 200 and 300 would be at that point before starting that capacity increase. So trying to figure out, I wonder if you could answer what that split of capacity is at that point so we can try to calculate that.
Yeah. I just have to grab my notebook real quick. Sorry, I'll be right back. 1 second, sorry. Sorry, Richard. I would say that to begin with, after I would say 27, mid 28, all of the growth that we have in SiGe and SiPho, and definitely in SiPho, will be in 300 millimeter. The 4x increase in capacity in Japan, the agreement with METI is really focused on optics, and it's on the silicon photonics and silicon germanium. So as a minimum, we would intend to be adding 25,000 wafer per month silicon photonics capacity. That can go much, much higher than that. And that's the desire of the company, of the country. So if you multiply that by 2.25, you're dealing with, very, very big amount of wafer capacity versus 200 millimeter. So although I'm not sure why it's so important for you to know that ratio to model something, the growth in silicon photonics is quite big, and the predominant portion coming out of track 1, almost 100% of it will be silicon photonics. You have the delta numbers in revenue from the previous model to the present model. And then when we go into the 300 millimeter facility, the actual split we've not yet announced, but the predominant portion of everything of that 4x growth will be in silicon photonics, and the next biggest portion of it will be in silicon germanium.
Okay, thanks for that. I'll just state, Russell, I think everyone's trying to figure out what the next update on the business model looks like. I think you said you update us kind of early-ish or some point next year here as well, trying to do that work ahead of time. So we'll look forward to more detail when you're able to give it. One of my follow-on questions here is on NPO, and I'd love to get a sense of the degree to which this will be a meaningful contributor in SiPho revenues in 2027. Is this going to be, how would you characterize the size, either quantitatively or qualitatively, please?
I think it will be significant. The exact percent I don't yet know, but I would think it will be not in the single digits, but in the tens of the percentage of what we'll be shipping, especially in the second half of the year.
Okay, great. That's very helpful. And then my last question is on advanced packaging here. I think there's a little bit of contribution in the track 1 investments in Japan, but I think a bigger part in track 2. So I'm going to ask a little bit longer term question here, Russell, which is, think of the fulsome of time here, after everything is built and how you think the market's going to evolve. How much of your silicon photonics related revenues are going to be packaging related?
That's a very good question. I'm not sure how much of it necessarily is packaging related versus being packaging enabled. So, even right now for the integrated laser, for an indium phosphide laser, we would see next year several tens of millions of revenue from integrated laser. The integrated laser is a chip to wafer bonding. That's packaging. It's right now outsourced, but we'll be bringing that in-house. So, it's not that we're getting paid per se for packaging, and we're not trying to compete with packaging houses. We're bringing more capability in-house that we have control over the end result, and certainly much more control over the start to ship time of wafers, rather than to depend on a supplier no matter how good they are. But we are not looking at per se competing in packaging. We're looking at packaging being an enabler to grow our core business at the highest quality, best speed to production of any supplier that there would be. Hopefully that answers your question, Richard. We're not going to separate a packaging revenue. We're not focused on it as a packaging revenue, rather than as an enabler for our silicon photonics platform.
That is helpful and appreciated. That's all from me, Russell. Thank you.
Thank you.
Thank you. And now we're going to take our next question. And the question comes line of Cody Ackley from Benchmark Stone X. Your line is open. Please ask your question.
Yeah, thanks for the quick follow-ups, guys. Russell, with all the capacity additions that have been happening around the industry from some of your peers at their global foundries.
Sorry, you broke up on the first part. I apologize. Could you start the question?
Oh, no, it's fine. With all the capacity additions around the industry from some of your peers, global foundries, ST Micro, Samsung, have all made announcements about planned capacity additions. If you can look out 12, 18, 24 months, can you maybe just frame your opinion of the supply-demand health of the industry with all of these different tranches coming in line?
Supply is certainly increasing. We have a definite benefit of anyone right now in that we're qualified at the lead customers worldwide with very strong contracts lasting through 28, and at this point, given additional capacity coming online, strong interactions and discussions to maintain contracts well beyond that. I don't necessarily have too good of a feeling for how much added capacity will be coming into the market. I've honestly not followed up on that so strongly. Our focus has really just been how we maintain sole share or majority share of our lead customers, and we're in very good shape there. The most important thing is something I talked about within the script, and that is speed. So as long as we have programs going on for not just next generation, but generation plus 2, in many cases generation plus 3, those programs always enable you to come to the market faster, stronger than anyone else. Tied to that, what's very, very real from a business standpoint, if we're working with a very large customer and we're putting substantial resources into next generation or multiple generation in the future developments, there's typically exclusivity agreements on both sides. And, we would enable a lead customer to have a head start, especially for any module that's joint developed, and we would request 100% market share. So I don't, again, for part of your question, I don't really have a good feel for how much capacity is additionally coming into the market. What I think we have a much better feel on is the market share that we'll be maintaining with our lead customers, and we believe that will stay extremely high.
And Russell, thanks for that. Is there, for my own edification, a figure of merit, stratification, I guess, that you can point us to that would be a good reference point, so we can just keep an eye on your continued leadership in the industry?
The figure of merit that you're referring to is what? I mean, typically a figure of merit is a technical achievement. What are you looking for? You're looking for something to measure our...
Well, I guess I'm just trying to gauge some of the industry rhetoric about differing capabilities from your different competitors around the industry. And I'm just trying to see if there's something you can help us with to help us better understand where it is that Tower really differentiates.
Sorry, I don't want this to sound facetious, but we differentiate in figure of merit. Insertion loss is probably one of the biggest things that one could look for. And if you have, at this point, a best-in-breed insertion loss, you really help the integrator, number one, by not needing to buy more expensive CW lasers because of greater output, but also the ability to reduce the amount of lasers that's in the package. We've press released before, it was a press release with Inolite about our insertion loss being an enabler to have the amount of CW lasers that they need in the package. So those are, I believe it was a halving of it. I have to go back to the PRs a couple of years ago. But that becomes really the biggest differentiator that we can have, is to lead the industry at figure of merit. If you're looking at next generation modulators, at the OFC conference, we did a joint PR with Coherent about being able to have done a 400G modulator in silicon. So, and there's no secret that we and maybe some others are working with thin film lithium niobate. We also are working with indium phosphide for a modulator. So the best way that one could be looking at maintaining market share is how close are you at working at the next generation or 2 generations out, and how is your performance in those areas. So if that answers your question, Cody, hopefully it does.
It does. That was very helpful. Thank you. And then lastly, you just did mention Inolite. I don't know if you had a chance, I know you're busy this morning, but to see some of the press reports that the administration is maybe looking to limit exports of Chinese technology into the U.S. From an optical standpoint. Just wondering if you had any thoughts there.
Many thoughts, but nothing that I would want to say publicly.
All right. Thank you very much.
Thank you. And now we're going to take our final question for today. Just give us a moment. And question comes line of Lisa Thompson from Zacks Investment Research. Your line is open. Please ask your question.
Good morning. Thank you. I just have two questions. First off, are you experiencing any shortages or supply chain issues for your own production? I know you worked on the indium phosphate issue.
Big picture, no. We're in very good position across the board with starting materials and with what we would call variable materials that are needed to manufacture. We were under somewhat of a crunch for indium phosphide starting material, and we believe that we've addressed that very nicely with the contract with IQE. But other than indium phosphide, which we had several ways that we went after to increase the amount of substrates during a difficult period, and I think that we've gotten resolved as well. No, we're in very good shape on supply.
Okay, and then my last question is, if we're going to do, say, an error analysis on your business model, where do you think the most variability of outcomes is? Is there going to be expenses or timing or the prices you forecast you'll get for your products? Where's the risk?
Yeah, I think I addressed it in my prepared remarks, that we are based on a few assumptions which are important. One of them is the selling price per wafer. The second is the cost assumptions, the time of installation and qualification. And the third one is that we will utilize 85% of the fab. And this is the basic assumptions for the model. I can say
right, but which has the biggest range of outcome? Which has the biggest range of outcome of, that could be the most important to look at?
Per wafer, because if you have more or less quantity, so you have more or less variable cost associated with that. But if the price goes up, it goes all the way to the bottom line and vice versa. So maybe usually, but it's a general statement. So usually the selling price is just 100% reflection over the margin.
All right. Thanks. We'll keep an eye on that then. Thank you. That's my question.
Thank you.
Thank you. Dear speakers, there are no further questions for today. I would now like to hand the conference over to Russell Ellwanger for any closing remarks.
Firstly, as I started the call, I'll end it with the same statement. I am extremely excited with where we're at, what we're doing, our future prospects. Enjoy being able to share them with you. One of the most exciting things about being involved in high-tech business, and maybe in particular being in management or the CEO, is the fact that in high-tech, nominally, you're interacting with groupings of people that are, from any statistical standpoint, in the upper end of intelligence. And that's, a wonderful thing, a wonderful place to be dealing with. When you couple that with people of very high character, it becomes fantastic, and it's wonderful, wonderful interaction. I can really state that if I look at across the board in business, but right now specifically on silicon photonics, every one of our customers that we have there, with really out exception, are just outstanding people that we deal with. And every interaction, it's more than joyful. It's a partnership to where you have open communication, you work with each other, and off of that you go into the next generations. We had a very good call the other day with a big customer with regard to having now announced, not announced, but to having very strong additional 300 millimeter capability. And the partnership feelings, the way that we're growing together, it's really an amazing place to be. And one of my really greatest joys about leading Tower is the ability that I have daily inside the company to be dealing with very smart people that are of high character, and being able to interact with customers that are very smart, of high character, and seeing the integration of both together towards making new things. We've talked multiple times, and it was in the script as well, not just of Tower's growth, but of Tower and our customers' growth. And in looking at things in that regard, in that respect, it's a fantastic way to be. So I truly, if we look at the financial model, if we look at, achieving a 33% net profit, just very, very thrilled about where we're at, where we're going, and all of these opportunities in front of us. The really extremely wonderful adventure that we're entering into Japan to build out a hub of optical excellence, for the SiPho, for the silicon germanium. We're really at an amazing place that everyone, not that we haven't in the past, but people come to work now even more excited than they did before. There's so much happening, and that's an amazing place to be. So in stating that, my invitation to everyone that's an investor, reach out. We'd love to talk to you. We'd love to have as much interaction as we can, help you better understand what we're doing, where we're at, and be able to share with you the strong results that we're having in the company. That being said, we look forward to engaging with the investment community at the upcoming Jefferies Conference, August 25th, 26th in Chicago, and at the Benchmark StoneX Annual Conference in New York on September 10th. The invitation for interactions with investors, it's real, and the better you understand our story, the better you understand where we're at, where we're going, we think the best for everybody. So with that, I'd like to close and just thank you for your interest and for your support. Thank you. Bye-bye.
This concludes today's conference call. Thank you for participating. You may now all disconnect. Have a nice day.